Hi, this is Jacqueline from National Mortgage Professional Magazine. I'd like to welcome you to today's webinar, sponsored by REMN, featuring Kim Jones. I'd like to thank all of our valuable webinar attendees for taking the time out of their busy days for this informative webinar and our ongoing series of webinars. If you have any questions during the webinar, please be sure to ask them on the GoToWebinar console. We will try to answer as many questions as possible at the end of the webinar. Without any further ado, I'd like to turn this over to Tony Durso.
Thank you, Jacqueline. Good afternoon or morning, depending on where you're located. My name is Tony Durso. I'm the corporate trainer for the sales division here at REMN Wholesale. I'd like to start off by saying thank you to all of you for taking the time out of your busy day to join us for today's webinar. Hopefully by the end of this presentation, we'll have eliminated some of the myths surrounding condo lending and given you a much better understanding of the condo project approval process. Presenting today's webinar is our very own Kim Jones, Vice President of Product Standards and our resident expert on all things to do with condominium lending. Kim has logged a total of over 30 years in the business and spent the last 20 of those years focusing specifically on condo financing. We sincerely hope that today's webinar helps you cash in on this booming segment of the real estate market. So without further ado, let me hand it over to Kim for today's presentation. Kim, it's all yours.
Great. Thanks, Tony. Thanks, Jacqueline. Good afternoon. Good morning, everyone. So are we ready to talk about condo and what's going on in our industry? So last year, I had the honor of attending a presentation that Fannie Mae put on in San Diego, and there was an economist there that works with Fannie Mae, and he stated that condominiums are truly here to stay. And what his prediction was is that over the next 10 years, community associations are going to represent at least 50% of the new housing. Now, I'm in New York, and over the last, 10 or 11 months, I've really seen a mass growth of new construction condominium projects going up here, specifically in the Long Island area where I'm located. So, and I know they are going up all over the United States, so just keep that in mind. And the reason why we wanted to do this call is to kind of give you a heads up of what's going on in our industry. Now, since, this prediction has been put out there, a lot of the investors, especially Fannie Mae and Freddie Mac, have really toned down, or maybe I should say loosened up on the guidelines to make it so much easier for lenders to start being able to lend in condominium projects because of this growth that's going to take place. Now, when you see community associations, that more than likely can be a condominium, right? It can be a PUD, or even your townhomes that are a style of a condominium. So we're going to talk today about really, what's happening. The first thing I want to talk about is you need to know when it comes to condominium lending, the two different types of reviews that every lender looks at. And these are very important to know because it makes a difference in the end of how the project is going to be approved. So now anytime you have a buyer that is going to purchase a condominium, no matter what lender they go to, there's always two different types of reviews that lender has to look at. And it's going to either be a full condominium project review or a limited condominium review. So if you have a new project, and let me tell you what a new project means. It doesn't have to mean new construction. It can mean any one of these 4 or 5 bullet points. So if you have a new condominium where less than 90% of the units have been conveyed, or if the project is truly a new converted project, if that project is still subject to additional phasing, let's say the HOA has not been turned over yet, or the project's not 100% complete. That project will always fall under the new project category, which means a lender must conduct a full review. Now, if the project is established, okay, all of the following of these must be true. So 90% of the units have been conveyed. The project's 100% complete. That includes not only the units, but also the common elements. The builder has completed the project, so it is not subject to additional phasing, and the HOA has been turned over. So you might be saying, well, why does this matter if it's a full review or a limited review? And honestly, the difference has to do with documentation that is required that the lender must review. A new project, a lender must look at all of the legal documents, budgets, a complete master insurance policy, where if the project is already established, a budget is not required. So the lender does not have to review legal documents. The lender does not have to review the current budget from the homeowners association, and not all insurance is required to be reviewed. So this really is a very important piece of information to know. Now, let's talk about myth busting, and this has to be one of my favorite things for all the years that I've been reviewing projects or speaking to realtors or even builders. And here's what's going on, and I'm sure most of you on this call today have probably heard this before. So you have a realtor that calls you up and says, oh, I have a condominium deal, but here's the thing. There's a litigation, so nobody can lend in this building. Or occupancy can't be more than 50% investor, and I have someone that wants to buy an investment unit. The project has commercial space, so no go, can't get any lending in this building. The developer still owns many units, and you hear, nope, this is cash only. So what's happening is not only do the unit owners who are trying to sell their units really believe all of this today is still going on, but a lot of realtors don't know what the current guidelines are and what can actually be done. You heard me say a few minutes ago that the investors are really changing their guidelines to make it much easier for us to be able to do condominium lending. And we're going to talk about all of these. The first one is the litigation. So I'm sure you're all aware of litigations. Either litigations are minor or they're major. And back in the day before guidelines started to change, and I think they started to change somewhere around July of last year to January this year. Before, if there was a litigation, it had to go in for an exception. Certain documentation really had to be reviewed, and there really wasn't much that could be done until that litigation was satisfied. So here are some of the examples and some of the things that are changing that are now considered minor. And the reason why I quote minor is if it is a minor litigation, you can still review, the lender can still review that project under the limited review, because the limited review is really the much easier, simple process way to go. So if it's a non-monetary litigation, that's considered minor, right? Some of those litigations I know I've looked at are litigations where the one unit owner is suing the HOA because the unit owner next to them, downstairs or above, has a dog that weighs more than 25 pounds. And don't laugh, because it's true. I've seen these litigations. And the legal documents stated that you can have a dog in this project, but it can't weigh more than 20 pounds. It had to be like a mini, tiny dog. So they sue for that. or somebody's smoking out in the common areas and the smoke is blowing into one of the unit owners and they're suing for that. They actually do a lawsuit, but they're not looking for any money. They're just looking for, those people to be told, fix the problem or follow the rules and regulations. So that is a minor litigation. If the HOA is the plaintiff and the result of the litigation will not have a significant financial impact on the project, if the HOA is seeking recovery of funds, so let's say there was a construction defect, and construction defects are probably one of the most common type of litigation. Let's say it's a construction defect, there was water intrusion coming in from the roof from one of the units, and the HOA had gone in and fixed the issue, right? You received evidence that whether it's an engineer's report or a roofing report to satisfy you that, yes, it was correct, the damage, the repair was corrected, and now the HOA just wants their money back from the developer, that's considered minor. Slip and falls. You see my little foot here slipping on a banana peel? Well, I'm in New York, so, with the winter time comes, I see slip and fall litigations all day long. So slip and falls can be considered minor as well. You always best practice, always ask for a copy of that litigation. You want to be able to review it. You want to be sure that the insurance carrier is going to defend the claim. You can also take a look at the current budget to make sure that it's not going to have a financial impact on the homeowners association, right? If they have to pay out these funds to get the issue corrected. But best practice, always get a copy of that litigation to review it. So litigations are not always a dead deal, okay? If you're not sure, ask your condo project department before turning away a loan. There are so many options today versus, probably 7 months ago, where a litigation today is now eligible. So keep that in mind. Litigations is one of the big changes and guidelines that have taken place. Again, because there are so many condo projects out there that do have some type of litigation. Conventional condo mortgages with less restrictive project reviews for investment loans. Now, this is a really big deal. If your loan is a conventional loan, right, with no credit overlays or additional pricing for this review type, no annual budget is required. Occupancy is no longer a guideline. So if you have an investment loan, it's a condo, right, that project can now be 99% investment as long as your buyer is going to put down at least 25%. But for the state of Florida, they have to put down 30%. So this is new. Investment loans being able to be underwritten under that limited review criteria. Again, as long as your buyer is putting 25% down, but good old state of Florida, you still have some exceptions and restrictions there. So the down payment would need to be at least 30%. I'm curious of how many of you knew this. So if your loan is owner-occupied or second home, did you know that the occupancy in that project can actually be 99% investment? That includes a limited review or a full condo review. Okay? So owner-occupied or second home loans, that project can be 99% investment as long as your loan is owner-occupied or second home. A lot of people I talk to today, realtors, builders, or even just other lenders when I do a lot of traveling and presentations, they're really like blown away from this because they're like, oh my God, you gotta be kidding me. You know how many deals we've turned down or, told them, unfortunately, no, the project has to be at least 50% owner occupied. We can't lend there. That's a myth. That is not true. Best practice I can give to all of you is you want to see if any entity that's, could be a one person, can be a developer, if they own more than 20 to 25% of the total units in that project. Because let's keep in mind, if you have a project with a high investment concentration, although it is allowed, you may have somebody that went in at one time and purchased a ton of units to rent them out, right, for some income reasons. So for the best practice I can tell you is when it comes to a project, whether it's a project review or you have a buyer, a borrower, see if you can find out from the homeowners association up front if you have a high single entity concentration in there. So this is new, and this is really good to know if you were not aware of this. Commercial space for those that are, may be in the New York area, the Boston area, where there's a lot of buildings that, you have your commercial space at the bottom, and then you have your condo units at top. Well, the guideline used to be 20%, and then it went to 25%, and now it's increased to 35%. And the reason for that, again, like I said in the beginning, is condominiums truly are going to be the way of living in the future, with all the new projects that are going up. So you may ask, so what's included when it comes to commercial space? How do I know, if my building has excessive commercial space? So if you have a project that may have, let's say, you may have a parking garage, and then you may have apartments, and then you may have the condominiums up top. Keep in mind that those rental apartments in between, they are calculated as commercial space. You may have a project that's part hotel, restaurants, retail, any commercial space that's even owned by the homeowners association. So that you want to include in your calculation to determine if the commercial space exceeds 35%. The good news is you no longer need to include commercially owned or operated parking spaces. So there's a lot of buildings out there, and I've seen them in my past where, we weren't able to approve projects where you may have a condominium project, and then next to that, attached to the building, might be a parking garage. Okay, if it wasn't owned by the homeowners association, maybe it was being operated by the retail space below the project, but it was attached. But that's parking spaces. That's a big deal. You no longer have to include them. I would say when you have any building, any condo project that has commercial space, ask the homeowners association if the commercial space is located or attached to the building. Now, when I said earlier, here in Long Island, I work with a big developer. He's built several condominium projects over the last year. And what he's done was he built the condo projects, and then down below, he has all this retail space. He has a movie theater. He has a Starbucks. He has a grocery store. You name it, it's there. And you don't have to count that commercial space because it's not attached to the building. The key here is attached. So any type of retail or space that's not considered residential, if it's attached to your building, it's commercial. So keep that in mind. Review the appraisal reports. The appraisals come in, take a look at them. Legal documents will 100% tell you not only what the commercial space is, but it will also give you the square footage. So don't think just because a project has commercial space, it's a dead deal. It can't be done because, there's a lot of changes, and here they are that have taken place that, making you aware of. Another great thing to know is about single entity ownership. So one entity can now own 20 to 25% of the total units in a project where a project has at least 21 units or more. Here's the good news, and I know if any of our folks that are on the call are in the Massachusetts area, I work a lot in that area. There's a lot of, I would say, jurisdictions, affordable housing, units that are mandated by the city that are not allowed to be sold. So you do not need to count those units against that entity. So units that are owned by the developer that are vacant and on the market, you do not need to count them in the single entity ownership. If it's mandated by the city, so when a developer goes in and he's going to build a condo project, he may make an agreement with the town that says, okay, I'm going to build this condo project. And, one of the things the city might say is, fine, we're good with that. We're going to give you permits and everything and allow you to do that. But we want you to hold, let's say, 25% of those units for affordable housing, or maybe for a specific town authority area. Like I know there was one in Massachusetts where part of the city wanted their employees to be able to commute and live in those units. And that's okay, as long as it's in their legal documents. So you don't have to count those units against the entity either. Here's a big major change where you can actually go up to 49%. So one entity can actually own up to 49% of the units in a project. Now, if you remember back in the day, right, condominium projects were being built. We took a really bad turn in our market where the developers could not sell the units. The market wasn't doing great. He had to hold on to those units. And in order for that developer to keep his income flowing in to be able to, pay for that project and make sure it was running properly and financially sound, he rented out those units. So now let's say, and we call those fractured projects, okay? So let's say, even if it's not the developer, but maybe you had an individual that went in and swept them all up in the time where pricing on condominiums was great, and they decide to rent them out. So if you have a project where somebody owns, let's say, more than 25% up to 49%, and now that individual says, the market's good, right? I can start selling these off and start making some money. If your transaction is a purchase and it is one of those entities' units, if you can get a copy of the rent roll from that entity to show when his leases are coming due, and maybe a contract from a realtor to show that he's contracted with a realtor so that when those units come up for rent, the leases end, he's going to put them on the market, you will be able to lend in that project, which is truly amazing. You don't have to go for an exception, but documentation is key. You want to be able to get all of that documentation so that you can show, yes, that entity does own a majority of the units, but now he's ready to sell. So keep your documentation. You always want to keep your documentation on hand for any project that's reviewed. But go out there. There's a lot of condominium projects out there, and I know, especially in the state of Florida, that took a really big hit where the developers had to keep a ton of units. And, it's changing now. So there's a lot of business out there Don't believe because one entity owns a majority of the units, that project is no longer eligible for financing. Here's a condo. I like to call this a hot spot because this is really, really good to know. So all conventional condo project approvals, they are actually now good for 1 year. So each time, let's say you have a condo project approved where you're at, and it's conventional, it's going to go to Fannie or Freddie. Each time a new loan comes in for that condo project, and it's on the approved list, I call it your approved list, our approved list, the project does not need to be re-underwritten. The only thing you may have to do is update the homeowner's insurance because it most certainly can expire throughout the year. And just think about this, because I was at a realtor event that I did about 2 months ago, and I brought this up. Some of the realtors said to me, you know, Kim, not only do lenders go against other lenders trying to get that loan, but we as realtors also go up against other agents trying to win that sale. So think about it. You have an agent that you work with. You go to that realtor and you say, look, we have this project approved. I see you have a listing there or a potential listing. You can go to that seller and say, look, at ABC Mortgage has this project approved. Let me be your agent. Because you know the buyer has to be approved and their condo project has to be approved. That is a win-win for both of you, for you, the lender, and for your agent. Because if the seller is thinking, gee, I don't know which agent to go with, and once that realtor says, I have this project already approved, that's a home run. Because we all know, right, what it takes to get a project approved. So keep this in mind next time when you have a project approved. It's a great way for you to market and go out there and talk to your realtors about this. Condo financing, some of the programs, FHA, if you're not familiar with. So for FHA, in order for you to close an FHA condo loan, that project has to be approved on the HUD website. The good news is, let's say your project is maybe about to expire and you have a loan. Keep in mind, you have to order that case number before your project is going to expire. So as long as that case number is ordered before the project expires, there's no deadline on when you close that loan. If the project expired already, but maybe it's within the last 6 months, you're not past 6 months yet, you can actually do a streamlined review. It's so much easier. There's limited documentation that's required, and it's a real simple process. Now, I don't know, here at REMN, we have the authority to underwrite, in-house for HUD. For those lenders that are on the phone that also have the ability to do that, keep in mind, of course, in the state of Florida, nobody can underwrite for HUD, right? The good news is, the FHA projects expired, withdrawn, and not in the state of Florida. Those projects have to be underwritten by HUD. Other than that, turn time is like 24 to 48 hours once you have the documentation. I have on here, which everyone will receive a copy of the deck, is the link if you're not familiar with how to look up a project. If you're interested in doing FHA financing, how you can locate that project on that site. VA must be approved on the VA website. Once it's approved for VA, it's always approved. They never expire. Yes, they never expire. The only time you may see a project go from approved to declined is if a lender went out to the website and they said, oh yeah, the project is on the site. Maybe they're speaking to a realtor, and then the realtor says, oh, do you know there's a huge litigation going on in that project today? Well, You were just informed of a huge litigation going on in that project. So to protect yourself as well as your buyer, you're made aware of a situation. That's something you're going to want to look into and bring it to the attention of VA if it's brought to your attention, because there could be a potential risk there. But other than that, they don't ever expire. They stay approved forever. Condo approval hotspots. So, with, like I said, with the new construction going on or new conversions going on, 50% turning into condominiums, there's an exception process in place now for things before you could not get done. Again, investors are making it so much easier, or trying to make it easier for us to be able to do more lending in condominium. So projects with delinquent assessments, excessive commercial space. I talked about the commercial space being going up to 35%. I've seen where you can probably get an exception on that. Don't want to speak for all. Maybe up to 40% if your appraisal has similar comps. Doesn't have a negative effect on the marketability, right? That's very possible. Pending litigations, if you have some real major pending litigations, you may be able to get an exception. I want to go right down to the reserve one because that's huge. So, reserves, we have to look at a budget. If you need to do a full condo project review, okay, if your buyer's doing an owner-occupied loan and they're not going to put down at least 10%, that budget is going to be required. So if your budget, your annual most recent budget, 2019, does not have at least 10% in reserves, you're going to need an exception for that. You may say, how do I calculate reserves, Kim? So you take a look at the budget. If the annual HOA dues are $100,000 a year, on the budget, scroll down on the left-hand side, there should be a line item titled Reserves. You want to make sure that is at least 10%, which would be $10,000 in the example that I just got. If it's not, again, there's actually an exception process in place now where you may be able to overturn that. Excessive single investor concentration. Let's say you have an investment loan and that buyer cannot put down 25% or 30% in the state of Florida. You're going to need a full condo review. And the guideline for that is it must be at least 50% owner occupied. And if it's not, you may want to think about having to go for an exception process through the investor that you're working with for that to see if they will give one. So this is something new that came out in January of this year from Freddie Mac of the exceptions that they are looking into being able to do for us. So keep this in mind. So I want to talk about, I know we covered a lot, and I could sit here on the phone all day and talk condos all day long, but of course we don't all have time for that. So some of the key takeaways I want to make sure that you take away from this today. Ask before just thinking it can't be done. So if you're hearing from a realtor, if you're hearing from a buyer, maybe a customer you worked with in the past that wants to buy a condo and they're telling you these myths that are going on, don't say it can't be done. Dig deeper because things are changing. Investor transactions are now eligible for a limited review. Exceptions truly are possible, not always non-warrantable. And I always tell everyone, in my area that I work with, all my sales folks, I never like that word non-warrantable. I haven't liked that word non-warrantable in 20 years. I love speaking to the investors and trying to find a way to make that work. FHA projects can be underwritten in 24 to 48 hours. Conventional project reviews are good for 1 year. So tell all your realtors this. If you have that project approved, it's really a great thing. Here's a few quotes, and you may not have heard these before. A good borrower does not make a good project. And that probably has to be my favorite thing, because I do hear this quite often, where I will have someone tell them, I tried to get an exception, it just can't be done. Well, Kim, my borrower has an 850 FICO, they have $1 million in the bank, their LTV is 10%. Why can't you get that condo project approved? Think about it. Is your buyer, your borrower, our borrower, going to hold up the financial impact for that building, that condo project that they are buying in if something major goes wrong? No. So a good borrower does not make a good project. There are no shortcuts when it comes to condo project reviews. They demand an essential skill and attention to detail. This is huge. So not everyone out there can underwrite condo projects. And I wouldn't expect everyone that's not underwriting condo projects to know all the ins and outs. But keep in mind, there are ways, of getting exceptions. Try everything possible before just saying no. Can't be done. I want to thank you very much for your time, and I'd love to open it up now for some questions. So I want to turn it back over to Jacqueline.
Hi, thank you so much, Kim. We have a lot of questions. Satish wanted to know, is Freddie or Fannie going to ease up on the restriction on the percentage of owner/renter?
The percentage of?
Owner and renter.
Well, again, so I'll go back to where, if you're talking about occupancy, if your loan is owner occupied or your loan is second home, that project can be 99% investment. If your loan is an investment loan and you are going to do the limited review, remember I talked about the 25% down or the 30% down if you're in the state of Florida, that project can be 99% investment. The only time we're going to look at the occupancy is if you need to do a full condo project review on an investment loan. It does need to be 50% owner occupied. If it's not 50% owner occupied, you can always go and submit an exception to Fannie or Freddie and ask, tell the story, why they should approve that. What's so good about that project?
Great, thanks so much. Sue wanted to know, on new project review, can that be CPM or does it require PERS review?
So CPM really is truly a guide. It's actually not a requirement that you use CPM. I love CPM. I've always used it because I love all the information that's in there. So it's excellent to use for CPM. You can do a manual underwrite. Both Fannie and Freddie allow that. I always recommend best practice to use CPM, but it's not a requirement.
Great, thanks so much. Pauline wants to know if a gym is considered to be commercial, even if it's only for the residents' use.
No, it's not.
Great. And Deborah wanted to know, will we be seeing any easing on the building law ordinance?
Yeah, stay tuned. I know there is an event going on in June, I believe it is. There's a couple of them with Fannie Mae, and I know their insurance team will be there. The building ordinance and law, that is a big deal, but always check to see if it's available in the area. So if the homeowners association doesn't have it, see if it's available in that area. It may not be. And then if it's not, and you can get something in writing, then you would be okay with it. But building ordinance and law, also really for these new construction projects, they should have it. So that's all I can really speak about that. But you may want to stay tuned to see what happens in the next few months to see if any of the insurance guidelines ease up any.
Thanks so much, Kim. Jack wanted to know if condos are restricted in any way with asset depletion loans.
An asset depletion loan. I can't answer that because I'm not sure if he's asking if there's a special assessment or if there were loans taken out on the HOA. So that one I probably need a little bit more information on.
Okay, sorry about that. Doug wants to know if he has a loan that's owner-occupied and his buyer is putting down 5%. Did you say that the occupancy in the project does not make a difference on full condo review?
That is correct, but please be very careful that no single entity owns more than 20 to 25% of those units, because then you're going to need an exception. But other than that, if your loan is owner-occupied or second home, that project can be 99% investment.
Thanks. Mark wants to know, are the exemptions only based on the qualified exemptions listed in the selling guides, or can they be beyond that, for example, the single entity ownership guideline?
Well, the single entity ownership, Freddie Mac will go up to 25%. Fannie Mae will go up to 49%, as long as, when I talked about, if that one entity is looking to sell his units, you can get the rent roll, you can get something from a real estate agent. If your purchase unit is one of those entity owned units, then you don't need an exception for that.
Great, thanks. Tom wants to know, for Fannie and Freddie pre-sale requirements, do the units need to be conveyed, or do they just have a sales contract to count towards the pre-sale requirement?
And so the requirement is 50% in new construction. And it also depends if it's marketing phase or construction phase. So it's 50% of the units, and you also have to make sure those units are substantially complete. That's very important to know, whether you're doing it via phase or the whole entire project. So the units have to be substantially complete, which is only subject, left remaining is buyer's preference. But the key is 50% conveyed, sold, or in contract, which is sold, closed, or in contract.
Great. Veronica wants to know, does the 99% investor owned, will that work for a Fannie Mae Home Ready or Freddie Home Possible that needs full review? Or can we do Home Ready, Home Possible on condos that have commercial space?
So that was two different things. So the first thing was occupancy. Can it be 99% investment? It can be 99% investment if you're selling it to Fannie and Freddie and your loan is owner-occupied or second home. Commercial space, you don't count commercial space as residential, number one, keep in mind. And the commercial space is its own separate guideline. You can go up to 35%.
Thanks so much, Kim. Mary wants to know, are these guidelines the same for jumbo loans?
Some of the jumbo lenders are accepting Fannie's and Freddie's new guidelines that come out. I would highly suggest you ask your investor first if they are following Fannie and Freddie's new guidelines.
Great. Tina wants to know, she's working on a condo loan today, and the project has a litigation where the HOA is the plaintiff suing the developer for water defects in the common areas. Is this type of litigation eligible?
So you want to make sure, first of all, you make sure you have the entire litigation. Find out what the defects are. How you have to review it, right? Do your due diligence, depending on what they are. So were the repairs done, and now the HOA is only suing for to get their money back? You're going to want to review the budget. Are the repairs more than 10% of the funds that they have in their budget for reserves? Is the insurance carrier going to defend the claim? So you really want to do your due diligence. See what the construction defects are. Do they cause a safety issue, safety hazard, habitability issue for the unit owners? Depending, kind of sounds like it wouldn't be, but I can't make that decision for you. You really, as the underwriter, have to review it.
Stephen wants to know if you've heard of any news on possible FHA spot approvals.
Oh, thank you. Yes, that's a great question. I have. So as you know, in January, we thought the spot approvals were going to come out, but due to the shutdown, that was delayed. And then we thought, my last conversation was a couple of months ago, we thought it was going to come out this month in March. The latest I've heard from Washington was they are now looking at May. So still needs approval. We're still hoping for it. And if that comes out, for those of you on the call that don't know what a spot approval is, they were around so many years ago. We don't know what they're going to look like, but it's a much easier process. It's actually approval on the unit versus the entire project. Again, we don't know what FHA, if they're going to change the process or any of that, but hopefully in May, we hear something on that. That's a great question.
Thanks so much for that answer. Mike wants to know, what if the commercial space in his project exceeds the 35% guideline?
I would suggest, Mike, that take a look at your appraisal. Does your appraiser have, definitely you want to get similar comps, right? That's number one. Number two, you want to make sure that the appraiser, if he's notated, if it's going to have any negative effect on marketability. So if you have those two things, I would suggest that you do an exception and send it over to Fannie or Freddie along with your appraisal report and a good write-up. Make sure your budget's strong and everything else in the project is strong as well.
Thanks so much. Jim wants to know, for new construction, will Fannie ever allow 30% pre-sale like FHA? Is there any considerations for change in the future?
Oh my gosh, I hope. I truly hope. That's one of my topics when I see them in June. So that would be great if they do change that.
Great, and we're running low on time, but Gladys wanted to know, are you saying that if we have a project that has rent protected or rent stabilized units, that she doesn't need to count those units against the entity?
Well, it depends. Well, if there are rent regulated, I guess you call it rent stabilized, where they are not allowed to sell those units, put in for an exception for that. I would definitely go to Fannie Mae and ask for an exception. They may come back and tell you an exception is not required based on their new guidelines, but it definitely doesn't hurt to put in for that exception.
I had quite a few people asking if the new updates on condo review rules are all just from REMN guidelines, or are they FNMA and Freddie guidelines also?
No, they're in Fannie and Freddie selling guide.
Great, and that is about all the time that we have today for questions. So I would like to thank Kim and Tony very much, and thank everybody for attending the webinar. And if you have any questions that we did not have time to answer, they'll be sent to Kim, and you can also email your questions to webinars@remn.com. Have a great day, and we'll see you on the next webinar.
Thank you very much, everyone.